Good morning. You're watching The Market right here in 18 Hour with me, Aisha Faridi. I've got Aman Dabash and Nikunj Dalmia as well joining in just a short while from now. For the markets, it was a bit of a rough patch. Expiry day jitters clearly played out and we managed to cool off from the session top, just about defending that 19,650 mark, which has acted as a key support for our markets. But before anything else, let's also highlight what are the cues coming in this morning. And it was clearly a macro surprise coming in from the US. The Q2 figures for the economy have come in and it's accelerated to about 2.4% for the April to June period. The GDP estimates as well, they managed to top the estimates of 2%. So that's a bit of a surprise coming in. Remember, US futures, while we were closing in for the day, were in any case holding quite strong. And on close as well, while it's not been much of a cheer coming in, but the futures pretty much anticipated this kind of a good news coming in. The US economy has been sporting resilience in the face of the recession. So, that really is the key takeaway, Avan. And if you were to just look at the annualized GDP prints coming in, for Q2 FY23, it's actually the strongest that we have seen. Of course, Q4 FY22 was a little bit stronger than that. But at 2.4%, it's not looking bad at all. So that really poses a question to just the price action from Fed coming in yesterday, wherein after that 25 pips hike, they indicated that there could be more in the offering. So now it's a tougher battle or a tougher decision really for Fed because the growth numbers are looking impressive. But yes, inflation continues to be high. So it's going to be a bit of a tightrope walk, but only makes the case stronger for maybe a pause in the next Fed policy, whenever that is.
Yep, that's what we could see. But overnight as well, you did have the US markets, which wrapped up the trading session mildly in the red, as they're looking forward, of course, to what the inflation gauge could be by the US Fed. So down by 0.6% for the Dow Jones, the S&P 500, as well as the NASDAQ wrapped up the day in the red. And ahead of the Bank of Japan's rate decision later today, you've got the Asian markets as well that look rather jittery. So for the most part, it's a cut that's in excess of 0.5% for the Asian markets. That is, with in fact the Australian as well as Hong Kong markets seeing the deepest cut. But let's discuss our own markets then. And yes, you said the expiry jitters were pretty evident in yesterday's trading day. You have a choppy session that played out on the wallstreet yesterday. The Nifty didn't even manage to sustain that mark of about 19,700 on the close. And the disconcerting factor perhaps is that you had the FIIs, which clocked in a sell figure, and that too, it wasn't a minor one. 3,900 odd crore rupees has been the most since February 28th. So that continues to be a little bit disconcerting. But your sole sectoral gainers came in the form of pharma. 4 straight days on the trot that index managed to gain. Real estate as well, that continued to be a smart mover. So that is how the markets wrapped up. So could Aisha pretty much describe it as a choppy day gone by? What about the series gone by?
The series, well, we've had a 5th straight series of gains coming in, second best expiry this calendar year so far that we've seen. And remember, it's in this series that we just fell short of that 20K mark, so historic highs in that sense. But yeah, the August series trend as well, if you were to see, while we may not have performed the best August that we've had in the last many years, but it's not been bad at all given how the construct of the market has been year to date. And if you were to just look at the series returns from the start of the year up until now, the financial year that is, March was a minuscule 0.3% gain. Remember, we were coming just about out of all the budget news, all that happened with the Adani Group stocks. That is something that the market digested in the March series. So from that minuscule gain of 0.3%, April we came back strongly. About a 4% return is what the Nifty saw. And then, of course, from there, tapered down to 2.5% in the month of May, 3.5% for June, and 3.5% for July as well. Would be interesting to see what the series ahead throws up for us, considering we would be drying up with Qs because a large part of the earnings, remember, is behind us. So So in that sense, we'll see what the market actually has, for us to offer. I think the biggest takeaway has been how the Nifty Bank has actually performed in some of these monthly series. And again, I stack it up from the start of the financial year. In the March series, it was a negative return of about 0.8%. From there, we came back to a 4.5% return. And for the July series, we've had a 5% return coming in for the Nifty Bank. So I think that really is the biggest takeaway. But yes, also important, what the street is going to digest is going to be the ITC hotel business demerger and the details that came about, Avan, in the conference call yesterday.
Yep, there was that conference call that was held by Sanjeev Puri, the managing director and chairman, and he came out with a lot of explanations, in particular why the company has chose to retain that 40% stake in the demerged ITC hotels. In fact, they said that the demerged entity is going to have a royalty-like arrangement for the use of the other ITC brands and assets. They said that they will stay invested in the in the hotel business, and it's going to have a strong balance sheet. It is also going to be debt-free, and it can also raise capital down the line. This could be via debt, equity, or even from strategic investors. He's also said that this new entity, which is ITC Hotels, is going to be able to raise capital from strategic investors when required, saying that they are going to work on a asset-light model that will require a modest amount. Also went ahead and said that the demerger is going to be completely tax neutral. The financial ratios he stressed on is going to improve substantially. ROCE could increase by 18 to 20%. The net assets will be at about 6,000 crore rupees. And they said that they will look at a strategic partner perhaps more sharply within the hospitality industry, but stressing on a debt-free balance sheet. In fact, let's hear it out then from the top brass of ITC, Sanjeev Puri, as well as Supratim Datta, the CFO, talking in the conference call last evening.
Certainly, they will improve substantially.
The transfer into a separate company where we will have 40% stake, residual stake, as ITC will therefore really mean that it is going to be accounted for like an associate on our balance sheet. So if you look at segment ROCE, which is segment EBIT in aggregate divided by the total segment capital employed in all our operating segments, that ratio to my mind should improve by 18 to 20 percentage points. Of course, these are based on FY23 numbers. The actual numbers will obviously be struck when we get the approvals and do the actual accounting entries. But ballpark, I think 18 to 20% segment ROCE improvement is something that we should expect. Second, apart from the segment ROCE number, is the overall return on invested capital, or ROIC. That number we expect to improve by in double digits for sure. ROIC, as you know, is a post-tax. Generally, people do a post-tax ROIC, so it's no pat on the invested capital. And that ratio should improve by 10 percentage points around that double-digit kind of mark. Balance sheet is for the hotels entity on its own. It's not about accessing ITC's balance sheet, of course. When it's demerged, it's a separate entity. So if you look at the capital employed of this business in FY23, March 23, the net assets are about 6,000 crores. So that's a very good start, and there's obviously going to be no debt.
What this company will have is a very strong balance sheet, a debt-free balance sheet with very strong assets of something like a few thousand crores. And it would have the capacity to, fund the asset-right strategy with the free cash flows it's generating. It has got a good free cash flows. It is doing well from a profitability perspective. But should there be need to raise capital, I think it has a strong balance sheet to go to the market, raise capital if it wishes to. It can also raise capital by way of equity or other investors who may be interested. Broad principle, we understand that all operating investments will move along into the new entity, unless there is a very specific, in a rare case, if there is a very, there's an exception or something special is there. So that's the intention. Non-operating investments will get, they have nothing to do with the ITC hotels. So therefore, they don't kind of move. So that's the broad principle with which we will be addressing these issues.
Okay, let's move on. We've got a power-packed lineup ahead. Lot of earnings to number crunch as well. But first, find out what's in store for us. Start of a new series, closing in for the trading week as well. Let me take it across to our chartist, Kunal Bothra, as well as Vaishali Parekh join in on the show right now. Good morning, both of you. Kunal, let me come to you. We did defend that 19,850 print, or rather 800 print, at least on the Nifty futures for the series gone by. And we're right now hovering around that 19,767 odd level on the GIFT Nifty. What's in store for us, considering the global markets are not supportive this morning?
Yeah, good morning, Aisha. So, it's been a bit of a tricky day in the last couple of days for the indices, because yesterday, for the first time, we saw some bearish engulfing patterns coming across for the indices. Now, the Bank Nifty yesterday made a new intraday high at the open, but then at the close, we were almost at a 6-day or a 7-day low in terms of closing for Bank Nifty. So that tells you the kind of sudden pessimism or negativity which has risen up in the banking index. The other factor to look out for is that the global markets, and especially Dow Jones, also yesterday managed to form a bearish engulfing pattern. Yesterday, the dollar index is from 99 levels to 101.5 mark. So the factors have changed for the indices or for the global markets in the last few trading sessions as compared to what was for the entire part of the July. And I think that's what the market would probably want to factor in. I believe now that we should be trading into a fair zone of 19,500 to 20,000. For the next couple of weeks. There could be a higher probability that if the profit booking rises for a few sectors, for a few individual names, large cap stocks, then we may even try and break below that 90,500 mark. But broadly, I think we should be still continuing this consolidation of this 500-point band.
Okay. Vaishali, hi, morning. What do you think is in store for us for this series?
Very good morning. Actually, yes, I am of the same view. Market has been a bit sluggish since a couple of days. We are seeing some move coming in, and again there is some pessimism coming in, some profit booking coming in. And yesterday we saw that yes, market is showing some resistance at higher levels for now. So till now, as long as Nifty holds on to 19,600 or maximum 19,500 levels, I would not be worried, but I would change my stance if 19,500 levels break. And likewise, Bank Nifty also, most of the banks, banking stocks, call it Axis Bank, ICICI, they all have done their run up. So I don't see much of an upside coming from these stocks. So Bank Nifty would be a hold right now with 45,000 as a support.
Right. Okay. Let's get in some specific stock ideas then. Vaishali, what's on your list?
So, I would choose one stock from the mid-cap, and that is Wockhardt Pharma. Yesterday, we saw good volume coming in, good momentum, and technically also, after a bit of consolidation, this stock has got into new round of momentum. So, I would say this stock is a buy with a stop loss of 225 and for a trading target of 270.
Okay, let's find out what's on Kunal's radar this morning. Kunal?
So one buy and one sell. The first one is a buy on DLF. Stock closed at the high point of the day yesterday, about the 500, 510 marks. So would suggest a buy with 525 as a target. Stop loss at 500. PNB Housing yesterday showed signs of correction. So that's a sell. Expecting the stock to get into a further correction. PNB Housing. So targets of 618. Stop loss at 650.
Okay, let's now talk about all the stocks that are going to be in focus today. We just flagged off the details coming in from ITC. Remember the fact that they are saying that post the demerger, the hotels business growth is going to be maintained at 18%. So that's an impressive set. But Anisha joins in to highlight some of the other stocks that you need to look out for. And Anisha, Indian hotels, I'm a little surprised. The margins have actually dipped.
Yes, and that's the only worry in the earnings, because other than that, it's a decent set of numbers coming in, because 16% growth on the top line is largely in line with expectation. The profitability was up 24%, but it was the margin that slipped a bit, came in at around 28% thereabouts. So a bit of a worry coming in, but do remember the stock has run up quite a bit. It's higher by 32% this year already. So maybe that's where the street might be not too happy with the margin performance that they've delivered. Having said that, it's not much to worry. Remember, the company did point out that there were elevated costs this quarter, plus the ARR has come down on a year-on-year basis, and that's the reason you're seeing a slight bit of miss when you look at the earnings as well. The company has also announced the room expansion plans. So of course, in the quarter gone by, they have opened 5 new hotels already, and the total number of hotels now stands at 191. They've also announced a couple of acquisitions as well. They have taken an in-principle approval for acquiring hotel in Zambia at USD $15 million. And then, of course, there's the lease agreement for Frankfurt Hotel is something that they're looking to sign as well. Ginger has performed all right this quarter. In fact, it's clocked a $1 billion milestone as well. So overall, it's not a very bad set coming in, but it's just the positioning that one will have to, factor in, because a bit of a miss coming in with respect to how the cost has remained elevated. Occupancy has been pretty much flat, so there's no reason for re-rating, and that's what the analysts are also saying. They've pretty much maintained their estimates. There's no spark in the earnings per se.
Yeah, and I'm wondering, with that 52-week high of 406, currently the stock at 384, what's going to happen there? Is the scope of disappointment more? What are the brokerages saying?
Well, Motilal Oswal has maintained their view. They are maintaining the target price of around 440. I was just going through what Antique is saying as well. Their target price is unchanged at 180. They're calling it a decent result, that the growth outlook remains intact. However, what Morgan Stanley has to say is something a bit different. They're calling it a miss on higher cost. They are maintaining the buy, but they have revised the target price to 445. They have rolled over their estimates. So overall, again, not much of a change in terms of the analyst thought process, because the growth outlook is intact, but nothing in this number to substantially re-rate the stock or get in more fresh triggers for it to trend higher.
Yeah, decent RevPAR growth, and I think every brokerage is alluding to the fact that costs are now catching up, but it's been steady momentum. Let's talk about the disappointing number then, and Anisha, that is Lotus Labs.
The numbers were disappointing, but the commentary is not. We were yesterday anchoring when we thought the numbers are really bad and the stock should take a pounding, and then suddenly it reversed. And we noted that finally the management has maintained their FY24 guidance, and even on the con call they sounded fairly confident, and that's the key takeaway. So probably today the stock will recover even further, because they are saying that they'll maintain the FY24 sales guidance. They're expecting a rebound in the coming quarters, supported by the healthy demand which they are seeing across portfolio. Margins too are expected to improve by here on. They are saying the improvement will be led by the raw material prices, which are better, and the utilization is something that will improve for them. FY24, they're calling a year of consolidation, but it's going to be a year of a comeback as well for them, because they're expecting that they'll close maybe around flat revenue over FY23, and whatever was the pricing pressure that we were seeing in earlier years, that has abated now. So that's the key positive coming in. The net debt increased, but and they said that it might increase a bit more, but they have a clear roadmap of bringing it down as well. So the overall takeaway is that the management sounded confident about their game plan, what they have in store. So maybe the street is giving them a benefit of doubt that this is a one-quarter blip, though they have disappointed consecutively, 4 quarters now?
Yeah.
But nonetheless, the street is keeping hope.
Yeah, and we saw that play out pretty much yesterday, as and when each of the, tidbits on the earnings were coming out, and the fact that they managed to maintain their FY24 guidance, you saw the stock recovering. But this is going to be one key one to look out for. Also, we are hoping to hear from the management too when they come out and speak to us in a short while from now as to how is it that they're so confident of, the numbers going forward. Let's move on, and before anything else, let's hear out what Jim Rogers, commodity guru, has to say about what's looking like the most overvalued and undervalued pocket in the market right now.
I guess that trade would be silver. Silver is so cheap on a historic basis, and inflation is not over yet. So I guess if I had to make one trade, it would be silver. The most overvalued asset class is probably U.S. technology stocks, because they're becoming absurd. I am not selling them as short yet, because I expect them to get more absurd. The most undervalued asset class, probably agricultural commodities, maybe the Chinese stock market, probably agricultural commodities.
Let's move on, and let's talk about some of the other earnings as well that the street is going to be looking out for. And Lisa is here to walk us through how Coromandel International's performance has been in the first quarter. Lisa?
Reported good set of earnings. It was an EBITDA beat for Coromandel International. Now, talking about the numbers, revenue, that was that was muted on year-on-year basis, but on quarter-on-quarter basis, it was up 4%. But what was a highlight was the EBITDA that grew 82% on sequential basis and 4% on year-on-year basis. And the EBITDA beat was mainly driven by the fertilizer business, while the crop protection business, that was a bit subdued, and it was on expected lines because of erratic rainfall as well as the higher inventory level. Talking about the fertilizer segment, the margin was largely flattish year-on-year and stood at 7,300 per ton, and it was on expected M2M inventory adjustments. Now, Axis Capital has come out with a note on the stock, and they have a buy rating at an SOTP target price of around 1,170 per share. And the management also highlighted the given outlook, good outlook going forward. They said that with the improved coverage of southwest monsoon across India, they expect that the agri inputs consumption that will improve going forward from Q2 onwards. Well, the con call is scheduled at 2:30 p.m. and we will update you on that.
Okay, so that was about Coromandel International, but a whole host of other stocks are going to be in focus as well. Yesterday, of course, it was Pharma which was leading the pack. So let's try and understand with our technical experts of which are the stocks within the Pharma pack which stand the tallest. Kunal, what's the name that you like?
Well, I've been advocating Sun Pharma as a decent chart from the larger cap name, Glenmark Pharma from the mid cap arena from I think 565 odd levels. Zydus Life has also done reasonably well. So I think these are the three names which I've been bullish on. But very recently, many of the charts for the pharma stocks have actually come back into overbought territory. Like for example, we spot the charts for Glenmark Pharma closer to 780, entering into the overbought territory. So I think the risk reward entering at current levels may not be great. The stocks, they generally get into last stage of momentum where all stocks and all stocks within the sector, most of the stocks within the sector, they tend to move up higher, but that may not be a best or an ideal time to try and buy these stocks. You also have to look at it this way, that these stocks are hugely divergent or significantly above their 200 moving averages respectively. So that's where the risk reward may not be fruitful. You have to wait out for a time-wise correction or at least a price-wise correction to try and chip into these names, not at current levels.
Okay, that's the take coming in on some of the pharma names which were very actively traded yesterday. M&M, that's the one key one which is to look out for, considering that 3% or over 3% stake buy in RBL Bank didn't go down well with the market. The stock cracked very hard yesterday, was down about, I think, almost 7% at the session lows. Vaishali, do you see any recovery in store for M&M? What are the charts telling you?
No, I would say currently, I mean, after a bit of a corrective move, we are seeing, I think it has taken support at 1440 levels. So I would say it's still a hold, but if 1440 level breaks, then there would be some corrective move coming in towards the target of 1400. So I would say not in a hurry. Let's wait and watch. 1440 holds to be a good support level.
Watching out for 1440 on M&M. Kunal, not sure if you've discussed ITC already, but Indian Hotels as well. What's your view on both of these counters?
Well, yeah, the stock earlier I think closer to 400 had taken a pause. Now, I think if I'm not wrong, the entire month of July series and maybe the second half of the month of June, the stock was trading into this 25-30 point band, 400, 405 as the resistance. I think closer to 380, 375 as a major support. So we are still yet not broken that 375, 380 support for Indian Hotels. Now we'll need to see that whether the stock today in the open trades below those levels, or in case if it falls further from that zone, that would probably determine that we could be at a rounding top formation for Indian Hotels. So the chart patterns over the last 1 or 2 months was indicating of more of a time-wise correction. But then it's very difficult to anticipate that which way the time-wise correction breaks out, whether it's on the upside or on the downside. So we'll wait out for that confirmation. 375, 380 as a major support for Indian Hotel. If that gets taken out on closing basis, then I believe that we could be looking at a cusp of a major reversal for the stock. Even a 330 could be seen into the stock price post that.
Right. Anisha just flagged off that ITC is the other one which is going to be in focus. And days after announcing the demerger of the hotel business, ITC management spoke about the rationale behind the demerger decision, saying that the financial ratios are only going to improve substantially for ITC. They also spoke about capital raising plans, reiterated that the demerger will be tax neutral as well. Vinny is in fact here with all the details from the conference call yesterday. Vinny?
main highlight that has come in, and there were certain important questions that were highlighted in the con call as well. Like in terms of the return ratio, yes, the return ratios will improve for ITC as well, because hotels business was a capital intensive business, so that will support ITC's ratios as well. And in terms of segment of the hotel segment, there also they are saying that the return on capital employed will increase by 18 to 20%. The ROIC, that will also improve to double digits, so we could say 10% around those levels as well for the segment as well. And financial ratios overall will be something that will substantially see an improvement. Now, other than that, in terms of the companies highlighting that what is the balance sheet going to be looking like for the hotel business, so they said that this is going to be a very strong balance sheet that will come in as well. The net assets over there are going to be of around 6,000 crores. There's going to be no debt on the balance sheet of the hotel business as of now in the starting. So obviously that's going to be a very strong balance sheet, and if ever the company wants to raise any money or any fundraising or capital that they want to raise, it will not be a tough problem for hotels as an individual entity which they are making. There won't be any problem because the balance sheet is very strong in the starting. So that is something that they could look at. As of now, they don't require any debt or debt raising or capital raising in terms of equity raising or any strategic partner as of now, but that would be a possibility. If there is a strong balance sheet, it could always work out well for the company. Other than that, in terms of, let's not forget, ITC has around 13% stake in EIH, so they gave a clarity on that and what is going to happen in terms of that investment. The management highlighted that all the operating investments will move into the new entity, barring the exceptional investments. So if there's anything related to hotels or any operational investment related to hotels, that would shift to the hotel business, but the non-operating investments, that would actually remain with ITC, because that's not related to ITC hotel, and that would continue to stay with ITC. So seems like EIH as an investment would stay with ITC, but that's too early for them to highlight, is what the management said. But this is an indication, is what we have gotten from them as well. And lastly, in terms of, if any other stakeholders are looking to sell the stake, whether you see BAT which is holding stake or LIC which is holding stake, and if they want to sell stake, would ITC look to buy? That was an important question that was asked as well. So what ITC highlighted is that no, that is not something that they would be looking at. They would be looking to maintain this 40% stake, and that is not something they want to look in terms of buying the stake of any holder if they're looking, or shareholder looking to sell the stake as well.
Okay, important commentary and important clarifications coming in from ITC on their hotel business. The key takeaway being that the capital requirement will come down substantially, and that's the reason the return ratios will improve significantly as well. But which are the other retail stocks that you can bet on? Listen in to which are the stocks that Pankaj Pandey likes.
Numbers were a bit soft for Shoppers Stop, largely because when you sort of look at the overall share of private label, that is intact at about 14%. Now, the challenge is that the companies have been offering higher discount because the overall sales have been tepid. And that, along with that, there has been a store addition, so that sort of impacted margins. I think we are yet to sort of see a revival in the overall retail sales. So I think that remains a sort of a challenge in the near term. But structurally, I think we like the retail space as a overall, and I think if Shoppers Stop is able to sort of increase the proportion of private labels, which is a high margin business, I think things will look a lot more better going forward. But near term, we don't see much of a price movement given the results.
All right, let's connect with Chakri Lokpriya as well, who's joining in on the show to get in his take on the overall fundamentals of the market. Hi there, Chakri. So much to talk about, but why don't we start off by getting in your thoughts on ITC, in particular the commentary coming in from yesterday's conference call where Sanjeev Puri talking about how the company is going to continue to hold a 40% stake, and he's also said that the demerged entity is going to have a royalty-like arrangement to house other brands and assets. Your thoughts?
Indeed, this is the long-awaited demerger from ITC, and now it turned out that they're not completely divested it for various tax reasons. It leaves the new hotel business in at least with a cleaner balance sheet compared to, let's say, Indian hotels, which has quite a high level of debt. Because hotels at a space, any company which has hotels usually tends to have very high levels of debt because of the asset-intensive nature, which today this ITC's hotel business does not have, has a stronger balance sheet. Therefore, it allows it to therefore get a higher valuation if and when the balance stake is divested at what looks like there's no immediate time. It also allows ITC to deploy its excess cash flow from its cigarette business and to the hotel business and the other businesses. So I think, but it's all in the price. And so I wouldn't really buy ITC at this point.
Chakra, you think the market was right in punishing M&M the way it did for its take buy into RBL Bank? I mean, yes, there are questions around capital allocation, but a 7% fall in M&M.
I think it's partly a couple of things. One is the stock has, had a very good run up. It's outperformed the market by some 60-70% over the last several months. And second, M&M has always been a sum of the parts story. And the sum of the parts story kind of got dented because of this capital allocation. But capital allocation, in a sense, again, given that M&M Financial Services is still a NBFC, and there is lots of benefits from a bank in converting to a bank. I think that while they haven't stated why they are acquired, I think there is something clearly brewing. And M&M looks okay, but if you look at M&M's fundamentals, this XUV business bookings are coming down. Their EV strategy is fairly well articulated. So I think the stock is fairly priced at this point, and there's not much upside in the medium term.
Okay, so that's the take coming in on M&M as well as ITC, both that the upside is capped on both of these stocks given the solid run-up that we have seen. But just wanted to get a sense from you, Kunal, regarding a couple of counters. They might be in focus today on account of earnings. Bharat Electronics, a blowout number coming in. Very, very strong performance, much ahead of street expectations, at least on the profitability front. And even if you look at Ajanta Pharma, it's a big beat versus what street was expecting. And their commentary going forward is also very, very strong. In fact, you have Motilal Oswal, which is saying that they have increased their estimates by almost 7 to 8%. Nuvama is saying that they've increased the multiple as well to 25x all the way from 20x, and they have a target price of 1850. Do you track Ajanta Pharma and Bharat Electronics?
Yeah, I do track both of them, and the charts technically for both of them are on the verge of a breakout. Now, Ajanta Pharma, I think 2021, in fact, June, July 2021, the stock made a high which is around 1360-65 odd mark. From there, it fell down to 1100, spent almost 1.5 odd year in this band of 200 to 50 odd points. So I believe that post the outcome of the results, hopefully the stock would break past about this major resistance. The volumes, I think, 2 day back for Ajanta Pharma in the price action was on the much extreme positive side, which means that the markets probably would have got some sort of an indication that the outcome could be a bit more positive, and I think that's where the stocks would probably get into a breakout zone. Bharat Electronics could be interesting bet. The stock was sideways for the last 2 weeks. 125-26 was the broad pivot range for Bharat Electronics. It's done reasonably well both in the last 6 months, 1 year, as well as over the last 2.5 odd years. But I believe on the short-term charts, the stock was a bit more sideways as compared to most of the other peers. So I believe hopefully that this could be a breakout move for Bharat Electronics. On the short-term charts, this bullish pennant formation indicates a target closer to 136 for Bharat Electronics. So we'll wait out for that kind of a target.
Right. Some of the other stocks are going to be in focus, and we've talked about Laurus Labs. Anisha as well flagged off that. And Chakri, this is quite the curious case, right? Their margins were at a multi-quarter low, also declined for a 4th consecutive quarter, but the management is confident of actually bouncing back, and so much so that they're managing to maintain their FY24 guidance. I don't know if you track Laurus closely or not.
Well, I don't track it closely. I think what is happening in the space is clearly it's become a volume business rather than a margin business. And still the market pie itself is very large, very underpenetrated market. So Laurus Labs, as well as its competitors, will continue to grow the overall pie, so therefore the volumes will come. But if you look at the margins of the business have been coming down, will continue to maybe stabilize at some point. So I think it's a volume game, therefore it will become a low multiple business. But clearly, I think they will reach their estimates given their volume growth.
Chakri, what's the outlook on IHCL? Having come out with a steady set of numbers, margins you could say was a bit of a disappointment, but overall they're talking about how their RevPAR, occupancy, ARR has been higher than the industry growth. Given with the kind of movement we've already seen in the stock price, what's your outlook on IHCL?
IHCL, again, a very similar story to the other hotel companies. The outlook for the rest of the year remains very strong. Both G20 corporate events and the upcoming wedding season towards the end of the year. All this will contribute both to the event business, to the hotel business. And the RevPAR is actually still kind of, if you compare it versus 3 years ago, it is still not up there. So given all this, I think, today their balance sheets are better than where they were before. And despite the stock run up, some of it is in the price, but I think these stocks will steadily move up over time. There's no more surprise element left in IHCL.
Okay, point taken. Vaishali, wanted your take regarding ACC. It was a very strong beat coming in yesterday. We have seen a lot of brokerages upgrade that one as well. Do you see a breakout on that? And what about Laurus Labs? Because we're all seeing a curious case of that rebound. Is that something on the chart which is suggesting a breakout?
So sure. First, let's talk about ACC. Actually, it's been going on for a long consolidation and it has already given a breakout. So the chart looks very robust. Yesterday, it gave a good close post results also. So I think keeping even from a longer term perspective, I would say keep accumulating the stock with the support of 1880, 1900 levels. I think in as a positional trade, this stock is likely to do 22 to 2300 levels. So my view is definitely positive on ACC. Now, talking about Laurus Lab, well, the chart looks pretty interesting. There is no damage right now. I would say it has hardly performed as compared to the other pharma stocks category. And it is in the process of making higher bottom formation. So as long as 335 level holds on as a crucial support level, I think this stock will be ready for a new round of momentum. But further conviction comes, so I would maintain a range of 335 to 375, 380. Further conviction for an up move comes about 380 levels, and I think then we would be ready for the next target of 400 to 420. So that is how I would look at Laurus Lab.
Okay. The other group which is going to be in focus is the Piramal group as well. Of course, the buyback opens today, and then, there were details coming in on Piramal Pharma as well. Just quickly bring up those stocks as well for you. Piramal Enterprises held out quite okay yesterday. If we can just bring up the 1 week chart perhaps, and then Piramal Pharma, wherein the rights issue price came about last evening at about 81 rupees per share, and it's a ratio of 5:46 that has been announced for Piramal Pharma. Now, Piramal Pharma, while in the last 7 days it's done pretty okay, a large chunk of the move has only come in the last 2 days when the street was pricing in or building in the rights issue post that announcement. These haven't been the best performing stocks, right? Liquid in nature, high beta in nature. Piramal Pharma, in fact, post the last quarter numbers, got really slammed as well. From there, saw a minute bit of recovery after last quarter's performance. And then now finally it's made it back to those 108 odd kind of levels. Chakri, what are you making of all the news flow that's coming out of the Piramal group? The right noises?
Yeah, they are the right noises. There is a lot of, divestitures, deleveraging, which is happening within the group. I think now it has become more of an investment group rather than, a business focused group. So now I think the focus will shift to with all the deleveraging that has happened. What will they do with what will be their next investment and what will be the nature of that investment?
Sure, point taken. But the other stocks which will be in focus on account of earnings are quite a few actually. So apart from Ajanta Pharma, Sona, BLW, there are others also reported a decent set of numbers. And overall, Macrotech Developers was a bit of a mixed set because the pre-sales and all of that is very strong for the company. But it's of course not reflecting into the PL in the same way. Chakri, what would you do about real estate right now?
I think real estate, given that we are close to an interest rate peak, hopefully, and at some point later in this year, when interest rate starts trending down, that does just two things. One is it brings down the working capital cost for all the real estate developers, which is a good thing. And the second thing, it also helps potential home buyers with lower mortgage costs, also a good thing. So a combination of both, plus the existing inventory with all the developers, including Macrotech, it'll help them in accelerating offloading it, and that will clean up, help their balance sheets become stronger because there's further cash.
In fact, just going through the numbers, while they've reported the best ever Q1 pre-sales, that of about 3,350 odd crore rupees, and that's an uptick of 17%. Macrotech or Lodha is what I'm talking about. What's driven it is a 27% or a 12% sequential growth in volumes, while realizations have declined for them about 8%. So yeah, lower completions and launches in the first quarter. collection decline of 8%. That's perhaps maybe sentimentally going to rub off on the stock, although the sector seems in an extreme bull run. In fact, at 10 a.m., we're going to be having an exclusive conversation as well with Abhishek Lodha and try get a better sense of which way their business is headed, whether we can expect a realization uptake, what are the new launches in the pipeline, and their sense on expanding outside the Mumbai MMR geography. That's something that we would like to highlight and hear out from Abhishek Lodha, but that conversation coming up at 10 a.m. Very quickly then, on the GIFT Nifty, it's indicating a mildly tempered start. Kunal, let's revisit what you're observing on the index charts now. Some consolidation in store, or do you think we're going to maybe drift a little bit lower?
So some consolidation more as of now, but then if the global market scenarios, they start to deteriorate, then I believe there could be more concerns which could be emerging that we may lower the band of this consolidation. So as of now, we'll stick to this 500-point range or a band for the index, say broadly 20,000 as a major resistance, 19,500 as a major support for the index. But then if the global market starts to get into a 3 to 5% kind of a correction, then we may probably lower the band towards 19,200 for the index. That would also be determined by how the market internals shape up. So in the last 2 or 3 phases of consolidation, time-wise correction for the index, for the Nifty in the last 3 or 4 months, the market texture has not deteriorated. Even on a day like yesterday, I think the mid-caps or the advanced decline ratio was more of flattish rather than extremely negative when you look at the 300-pointer kind of a downtick on the bank Nifty. So that itself is the positive sign for the markets. If the market breadth doesn't deteriorate, if the market internal still remains strong, then we may try and digest this kind of a consolidative move on the indices. But if that starts to deteriorate further, then we may have to lower the band on the support side for the index.
All right, let's hear out some top fundamental stock ideas as well. What is it that our guests have been betting on? Sanjeev Bhasin, let's find out his top idea.
Off to Reliance just when it was seeming that we are into a correction which we all were hoping for. Reliance comes out with this demerger. Now it's anybody's guess what the real play out will be, but imagine the threshold of a financial service business like Reliance. You remember how they got into telecom in a big way and the competition had to either move out or consolidate, and I think that is forthcoming now in their financial services business. By the way, these are all precursors to some of the large banks which have been underway on acquisition and so on, as the Bajaj Group has been. And I think that Reliance Financials will actually unfold, a lot of value creation which is there on the books. We know that their petchem and the oil and gas has reached a climax. It's only encashment of the investments. The retail business and the telecom is the new buzzword for them. So very, very innovative, and I would expect Reliance actually to lead the charge to 20,000 on the index.
Okay, so those are the views coming in from our fundamental experts. But what about the rest of the market? Because IT stocks, they have been doing all right despite the weakness that we have seen. Intellect Design also came out with its numbers. Tech Mahindra, despite a very bleak set, managed to see quite a bit of resilience yesterday. Chakri, what about the IT pack? Would you look at buying whatever weakness is there in the market right now?
If you look at IT, a lot of it has been company-specific weakness. Whether it was Infosys or yesterday Tech Mahindra, yesterday they had a specific client issues which led to both a revenue and a margin miss. And Infosys, it was actually, while they didn't point out individual clients, it was clearly something which was happening within their own portfolio base. And third, if you look at the overall, including the commentary coming out of the US, still a very strong economy, far stronger than expectations. And therefore, Fed continues its path of tightening rates, or at least maintaining a tough language. So as long as the tough language continues, I think IT will now take a back seat, and therefore I think at best it's a market exposure, but not anything beyond that.
What about your view on ACC? Brokerages seem to be, turning their view to neutral or an underweight rating post the kind of numbers that they delivered. Realizations have been a bit weaker. What's looking good within the cement space and your outlook on ACC?
ACC numbers were actually, I think, very strong. Their volumes number were very good. There was a cost moderation, but the weakness has been in the price realizations. Now, this is something which has hampered the whole sector, not including ACC. And it's unlikely, I think, from the current environment that they will be able to increase prices. What, with costs coming down, input costs coming down, petcoke costs coming down, that will kind of protect the margin. So I think, these stocks will have to still wait and watch. But ACC, because of a lot of uncertainty around the stock, because of the Adani holdings, etc. I think now the stock had corrected. So I think you can probably accumulate ACC, but still I think it's largely has done its bit of running.
In fact, Morgan Stanley has maintained their underweight rating on ACC, the target price at about 1650. I think there's something wrong with that because 1940 is already where ACC is. So yes, they are, saying that the CMP is not justified and they do see a lower level on ACC. They're saying that realizations were weaker, the cash position moved down significantly or rather slightly in the on a sequential basis, and that EBITDA was much higher than expected, led by higher volumes as well as lower costs. So that's their take on ACC. Nestle, that's the other one which is in focus. In fact, not just Nestle, the entire FMCG pack as well is going to be in focus. Jefferies has come out with a note on Nestle after its earnings. They're saying that volumes were offset by margin expansion. The revenue growth was broad-based across cities and towns and also product segments as well. That they like the packaged food story, but valuations are expensive for Nestle. More importantly, I think Nestle global earnings were out, and I think that is a bigger talking point because it's a 9% hike that they've actually undertaken, and considering at a global level, this is one of the largest packaged food companies. Nestle is what I'm talking about. So for them to actually absorb that kind of inflation and pass it on to the consumers with a 9% price hike across their product categories, that's something pretty big. But Chakri, what is your sense on, where the prospects of FMCG may be headed? And just in light of the commentary from ITC, the commentary coming in from Marico, and then yesterday on Nestle.
You look at Nestle, Unilever recently, a few days ago. It's a very similar story in terms of, there is not much of, and they're not able to pass through much of the price increases. And I think that's partly understandable at this point in time because, consumer confidence, consumer buying has kind of dipped in the last couple of quarters. And so I think they would rather focus on maintaining market share. So with the stocks already trading at 60 times plus, I think, this is a time to remain on the sidelines and not make any fresh buying into a Nestle.
Right, okay, that's the take coming in on the prospects of the FMCG pack. Let's just take stock of some of the other active movers in trade yesterday. So while M&M of course took a bit of a slam, as was the case with some of the FMCG plays like a Britannia, like a Nestle as well. But banks, that was also one really weak link. Axis Bank of course was reacting to its numbers. The stock fell 2.5%. You had weakness come in for ITC as well, which was down about 2.5%. And then Bajaj Finance as well, which closed in lower by about 2.5%, as did Reliance Industries. Kunal, it's the blue chips which are now getting stuck, right? I mean, Bajaj Finance, ITC, Nifty Bank.
Yeah, I think you've rightly used the word stuck because most of these large cap names are one of the major reasons why you're not seeing the index sustaining those levels. So yes, we've seen a breakout. Yes, we've seen a breakout for the banking index to the new high, 45,000 taken out, then I think 46,000 also taken out for the banking index. But the fact that these stocks, these indices have been unable to sustain those new highs, build onto those gains, we've not seen a bull market kind of a feeling where, you tend to buy the stocks, in momentum, and then over the next couple of trading sessions, you tend to see a follow through up move for those individual stocks. So I think the only reason for that is because large cap stocks have just participated on and off into this phase of the market rally. Look at the steep underperformance which is still there with the likes of HDFC Bank as compared to the other peers. Axis Bank is languishing sub the 1,000 mark. In fact, in the previous series, the month of June, the stock was one of the better performers from the private sector banking names. But this series, ICICI Bank has managed to lead the charge. IndusInd Bank has managed to lead the way ahead for itself. And the other stocks like Axis, etc., they've started to underperform. So it's this part and parcel phases for these stocks which have not participated. That's causing a bit of an impediment to the index moves. I'm not sure that by what time and what trigger would these banking stocks start to participate in a unison. But something, for example, from a different sector like what we saw for the pharma stocks yesterday, where most of the pharma stocks, the right from large cap names like Sun Pharma, Cipla, towards even the mid cap end like Biocon, etc., these stocks start to participate or show signs of rally. We've not yet seen that for the banking index.
Okay, let's get in a view, Vaishali, as to what the outlook is when it comes to some of these FMCG counters. You had a Colgate that spiked up yesterday, something like a Zydus Life or even an Aurobindo Pharma have been smart movers. What's your outlook on the charts?
A very strong uptrend, but I would definitely not recommend a new buy. So talking about Colgate or Oro Pharma, they've already run up so much. So maybe in between some whipsaws cannot be ruled out. But overall, for a longer term perspective, the trend is very much positive. So my view stays positive. But of course, one needs to be cautious at these levels as we are at a make or break levels in the index itself. So if we see some profit booking, then of course there would be some profit booking coming in these stocks as well. But yes, long-term view remains positive.
There's Bharat Electronics or BEL as well, which is going to be in focus. And I'm just looking at one of the brokerage notes coming in on this particular counter and their earnings performance. Top line, of course, was a 6% ahead of consensus. So it's a big beat in that sense. 66% higher than the pre-COVID June quarter revenue as well. PAT has come in higher, 50% than what the consensus on the street was anticipating. The EBITDA margin as well has seen a jump up of about 243 basis points. The gross margin for the quarter gone by, very stable at 43.5%. And the order backlog as well has seen an uptick of 18% on a year-on-year basis and a good 8% on a sequential basis as well. So Axis Capital, for instance, is saying that the implied Q1 order inflows, they stand at 10x on a year-on-year basis, and they're actually liking this particular stock. So that's BEL in trade for you. A good uptick of 1% is what it saw in an otherwise weak market yesterday. Let's see how the stock reacts to the earnings and, more importantly, the brokerage notes coming in on it this morning. Now, two stocks from the government stable, a BEL as well as RVNL, which also is a newsmaker.
Well, I'll start off with RVNL because I think that's a stock which has done exceptionally well last 1 year. 2022, the stock was almost at 20 rupees or 30 rupees. And now the stock is at 140. In fact, that's the high the stock has made. But then, one of the characteristics for RVNL has been that the stock gets into that odd phase of a very strong rally, which starts off for, the stock maybe in a couple of days, couple of weeks, or at max 1 or 2 months. But then the stock gets into that 5 or 6 months of consolidation at a stretch. So I believe RVNL is heading towards that kind of a start of a consolidation. So hopefully in the next 3 to 4 months, we could see lower levels. We could see more sideways range for the stock price. Would not be suggesting a buy on the stock at current levels. BEL, on the other hand, I would believe that the stock is ripe for a breakout. So that consolidation, which I'm talking of for the previous stock, that's already happened for BEL. The stock has gone through a triangular pattern, 125.26 as a range, pivot range for BEL as a support. So the stock has been hanging around this 125.26 mark broadly. So looking at the chart patterns, I would believe I would be a lot more optimistic for BEL from current levels. Would expect 136 as a near-term target for the stock.
Right. Okay, and as promised, here's tracking all the smart portfolios as well, what the veteran investors have been doing of late. And today we're picking up on Madhusudan Kela as well as Akash Bhansali as well. And Sharad is here to tell us what they have been doing in their portfolios in the quarter gone by. Sharad?
Well, yes, importantly, we have Madhusudan Kela for the June quarter. Interesting names coming up. The first one is Repro India with a new entry of almost 3.6%. Now, do remember the company itself is a proxy play to the national education policy, and the company deals with the distribution of books as well as digital services. Interestingly, Indostar Capital Finance also a new entry coming in with almost a 2.5% stake in the NBFCS space. But interesting small cap name coming up is Sangam India. Over here, his stake has actually increased by almost 470 basis points. And do remember the company itself is involved in the processing of yarns and in the textile space, especially in the first value of the chain. Now, because of this, this segment has been beaten down because of inventory issues as well as pricing issues. And we had recently reported also that there was certain closures coming in southern India. Apart from this, we have Akash Bansali over here with 4 new important entries coming for the June quarter. Natco Pharma. Kind of valuations have been attractive. That's what analysts have been stating. Titagar Rail has actually picked up on the orders, while Parag Milk and most of the milk stocks have been rallying because of price hikes and also lower procurement costs. And apart from this, the demand from Horeca segment has also been strong. And also another name coming up from NBFC amongst marquee investors is Praxis Home Retail with almost 2.1% stake.
All right, thanks very much. That is the latest update coming in with respect to the smart portfolios. Time for a very quick break with the news that the GIFT Nifty is currently down about 1/3%, 19,775. We'll be right back.